I think if Bitcoin goes up 140 basis points a year, we can pay the dividends forever and generate shareholder value, right? It's that small. And if Bitcoin goes up 0% a year, we have capital for the next 70 years. And in 70 years, we'll have to figure out to do something different. And we'll figure out what we're going to do to deal with it. But the company's financially very, very strong. And we have a huge number of financial options at our disposal because we are an operating company and any of them could be used if we needed to. If the insurance companies don't want to buy Bitcoin and the banks don't want to buy Bitcoin, or the index allocator doesn't want to support a digital treasury company, the free market is going to allocate capital and it will adjust. It just creates a bigger opportunity.
The story of Bitcoin can't be told through calm charts and steady lines. It begins with the chaos that gives the asset its power. Michael Saylor emphasizes that his company continues to accumulate Bitcoin aggressively, recently purchasing over $800 million worth. He explains that Bitcoin's volatility is not a drawback but an essential characteristic that creates opportunity. Without price swings, institutional players would have already absorbed all the upside, leaving no room for analysts, entrepreneurs, or forward-thinking investors to add value. For Saylor, volatility represents raw financial energy, something to be harnessed, not feared, much like fire and electricity powering transformative technologies. Michael Saylor argues that anyone investing in Bitcoin must adopt a long-term mindset. A 4-year minimum time horizon is necessary, and a decade is ideal. His company's mission, as he frames it, is to take a highly volatile, high-energy asset and engineer financial products that reduce risk for more conservative investors who simply want yield. He suggests that Bitcoin's explosive nature is what enables innovators and capital allocators to succeed, while those seeking stability should avoid short-term speculation and instead consider digital credit or traditional financial instruments. Michael Saylor outlining a clear framework for investors based on risk tolerance and time horizon. If someone wants to avoid counterparty risk and can hold capital for 4 years or more, Bitcoin is the preferred asset. If they want amplified exposure to the future of digital capital and don't need the money soon, owning equity in his company offers leveraged upside. But if an investor requires precise liquidity in the near term, safer credit instruments or even a simple bank account are more appropriate. He stresses that understanding whether you are a credit, capital, or equity investor is the key to constructing a rational portfolio. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I can't speak about that. We release that on a routine basis via 8Ks. But what I can say is on Monday morning of this week, we did buy $830 million worth of Bitcoin. So our last buy was just a few days ago, and it was quite a lot. You know, as I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon. 4 is the short term, 10 years is the long term. I'm an officer of a publicly traded company. And what are we doing? We are in the business of buying a high energy, highly volatile asset and stripping the risk and the volatility off of it in order to sell it to people that are much more risk adverse, that are much more volatility adverse, that just want that yield. And so if Bitcoin wasn't volatile, it probably wouldn't be high performance. And then our value added wouldn't be that great, right? Like, for example, I say to people, if you knew Bitcoin was going to go up 2% a month forever with no volatility, neither you nor I would be in business, because all the conventional finance investors, all the conventional journalists, they would dominate the market. Warren Buffett would own all of it, and there wouldn't be an opportunity for us. So I look at the volatility as it's a challenge, but it's also the bug is the feature. And I say to people, you know, volatility is Satoshi's gift to the faithful. he basically gave you the ability to rise to the top of your profession as an analyst, as a journalist, as a corporate operator, as an investor. And if the volatility goes away, no one cares about your opinion on any of this. It's like, you've got fire, and we've got the phrase burned. Fire burns you and electricity shocks you. And Henry Ford created an automobile, with a burning engine, with a fire in the engine. And we created electronic transmissions. And so you put electricity and fire in the car, and you've got a killer consumer product. And I think the key here is you got to look at this market and say, this is indicative of energy. You can harness the energy. You can't be scared of the energy, right? There are those people that run from the fires, and then there's people that put the fire in the automobile or the jet airplane. And we kind of need the people to build the airplanes and build the automobiles if we're going to move the civilization forward. So the volatility comes with the territory. My message is, if you have a 4-year time horizon or longer, if you have money you don't need for 4 years, and you don't want to take any counterparty risk to a currency, a country, a company, a culture, a competitor, then you buy Bitcoin. And if you're an equity investor, and if you want amplified exposure, if you want to invest in the future of digital capital and the future of digital credit, and you're enthusiastic about, like, we think we can sell a treasury credit product that's really compelling and very interesting to 1 billion people, right? 1 billion people would love to have a bank account that pays 10%. If you would like to invest in that future as an equity investor, and you don't need the money for 4 years or longer, then you can hold the equity. If you need the capital in the next 4 years, then you probably want to be a more risk-averse investor. You need to look at a credit instrument. And if you need exactly down to the penny, $87.17 in 2 weeks, you probably want to put your money in a bank or a money market, because that's just what you need. And so I think every investor has to decide what's their risk tolerance, what's their time frame, and are you a credit investor, are you a capital investor, or are you an equity investor? And then once you've made that decision, you can decide how to allocate your portfolio.
Michael Saylor explains that the company's dividend obligations are extremely small relative to both its liquidity and the broader Bitcoin market. With only about $2 million in daily dividend requirements equivalent to just 5 basis points of the firm's trading liquidity and an almost imperceptible fraction of Bitcoin's $100 billion daily volume, these payouts are little more than rounding errors. He emphasizes that the firm can meet these obligations through multiple avenues, whether by selling Bitcoin, selling derivatives, or using equity-linked options. Even modest Bitcoin appreciation around 140 basis points annually would allow perpetual dividend payments while still increasing shareholder value. And even if Bitcoin's price were completely flat, the company has capital reserves projected to last 7 decades, giving it ample time to adapt and ensuring long-term financial strength. Saylor also pushes back on concerns regarding index inclusion, MSCI decisions, or potential negative interpretations from institutional allocators. Each group eventually embraced Bitcoin once they understood digital capital and digital credit. While index decisions may introduce short-term volatility, he believes they are irrelevant to the long-term trajectory. If the global market demands a 10% digital treasury product and recognizes Bitcoin as superior digital capital, capital will naturally flow to companies positioned in this space, regardless of whether traditional index allocators participate. Let's get back to the interview.
If you think about it, we have a dividend obligation, and the dividend obligation works out to about $2 million a day. $2 million a day works out to 5 basis points of our trading liquidity. So let's say if the stock is trading above 1 times MNAV, then you're talking about a 20th of 1%. It's like nothing. But let's go to the situation where the stock falls below 1 times MNAV, and we don't want to sell the equity. We can either sell the commodity, Bitcoin, or we can sell derivatives on the commodity, or we may even sell derivatives on the equity. But let's put that in perspective. Bitcoin's trading $100 billion a day. $2 million works out to, it's like 2/100ths. No, actually, it works out to 1/5 of 1 basis point of all the trading of Bitcoin each day. It's like, it's not 1% of 1%. It's 1/5 of 1%. It's so small that it would pop up in the 5th significant digit, as a rounding error. So the company's dividend obligations are fairly de minimis. You can literally calculate them on our website. I think if Bitcoin goes up 140 basis points a year, we can pay the dividends forever and generate shareholder value, right? It's that small. And if Bitcoin goes up 0% a year, we have capital for the next 70 years. And in 70 years, we'll have to figure out to do something different. And we'll figure out what we're going to do to deal with it. But the company's financially very, very strong. And we have a huge number of financial options at our disposal because we are an operating company, and any of them could be used if we needed to. I think it's a bit alarmist. I'm not so sure the numbers are nearly that high. I think actually the numbers would be much smaller. I also think it's already priced into the market by a factor of 10 if you count it. I don't think there's any relationship between the decision-making of MSCI and the NASDAQ 100 or the S&P 500 index allocators. The company is an operating company. It's just like insurance companies use capital in order to create financial products, and banks use capital to create financial products. We use capital to create digital credit finance products. It's possible there are people in the world that don't fully appreciate digital credit or digital treasuries. That wouldn't surprise me. We had that challenge with bankers that didn't want to bank Bitcoin. We had that challenge with accountants that were a little bit skeptical of digital assets accounting. The accountants embraced the asset, the bankers embraced the asset, the politicians embraced the asset. We had the challenge with credit rating agencies, and they just embraced the asset. We're starting to get credit ratings. We have the challenge under the Basel Accords, where Basel Accords allocate zero value to Bitcoin, and now they've announced they're going to reconsider that. So I'm not concerned that we have these kind of concerns. I think we'll educate all of the companies in the space. Ultimately, it's above my pay grade to decide whether MSCI embraces digital asset holders or digital credit or not. It's just like it's above my pay grade whether the S&P 500 puts us in the index. But what I would say is, over the long run, it doesn't matter, because over the long run, this will create near-term volatility. But if the world wants a bank account that pays them 10% rock dividends, and if Bitcoin is digital capital superior to gold, then it's not going to matter what an equity index allocator decides. If the insurance companies don't want to buy Bitcoin and the banks don't want to buy Bitcoin, or the index allocator doesn't want to support a digital treasury company, the free market is going to allocate capital and it will adjust. It just creates a bigger opportunity for some other equity investor that will pile into this particular asset class and support these kind of companies.
Bitcoin's volatility, long-term growth potential, and the company's strategic approach to capital and dividends highlight a framework built for patient investors. With obligations that are minimal relative to market scale and multiple avenues to manage risk, the financial structure is robust and adaptable. Combined with the ongoing institutional and market acceptance of digital assets, these dynamics suggest that long-term value creation and market opportunities remain largely independent of short-term index decisions or conventional skepticism. The overall message is that disciplined, long-horizon investing in Bitcoin and related digital capital products can generate sustainable returns while mitigating exposure to transient market concerns. How can investors balance the high volatility of Bitcoin with the need for predictable returns in their portfolios? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.